What is up? What's going on, everybody? Welcome to another edition of Ask Your Real Estate Coach. And I'm your coach here, Johnny Lynum, the military CEO. And we're diving in today on a couple topics that I have seen come up from just social media posts, as well as just conversations that I have had with individuals, and just helping people better understand how do we normalize what's going on in our market today. And today we're going to be talking about the tactics. I'm the military guy. I'm always we live and die by our tactics. But guess what? If you're executing tactics, that means you should somewhere along the line have a strategy. And we're gonna talk about some tactics you can use, but also some strategy to help make sure that you're, as we like to put, you're putting iron down range on the right target when you're shooting. And we want to make sure we shoot that we hit our target. And so today we're gonna be talking about those tactics that you can implement in your investing business right now, today, to help you thrive in today's market. So, with no further ado, we're going to dive in and kind of talk about these three hot topics. We're not going to talk about everything that we could because there are a lot of different things looking across the landscape. One of the things that we had the pleasure with Faye, my direct operations, she had the pleasure of being in Dubai last week and just came back with a boatload of information on just potential investments from Southeast Asia to the Middle East to different opportunities here in the U.S. But today we're going to focus about topics that can help you. You bring in and implement right now today. And so that's the thing that I want you guys to think about, that there is a global real estate market and there are so many niches for you to focus on. But the thing is that you have to understand that you have to bring clarity to everything that you're doing. So today we're going to dive in on those three topics that every serious real estate investor should be watching right now as you're kind of going through 2025. As we're rolling in, we're wrapping up the first quarter. Actually, we're wrapping up going into the second quarter. And you got to make an assessment. How are you on your 2025 goals? If you don't have 2025 goals for your business, that's a whole nother conversation, a whole nother video. But number one, in the interest rate environment that we're in right now, because I would tell you, the more that everybody's talk about, everybody they get wrapped around the axle when it comes to interest rates. Interest rates, interest rates, interest rates. And I can't buy because interest rates are high. Like, okay, all right, cool. Let me know how that works out for you in 2 or 3 years while rates are still going to be high. You got to evolve and you got to have strategy. And so, number one, today, we're going to talk about creative financing in a high interest market. It is extremely important to understand that you need to have different tools in your toolbox for different market cycles when it comes to real estate investing. So, subject twos, where you're able to take over the existing debt that's on the property, you're able to assume that mortgage, and now guess what? You take in that mortgage, and if they bought in the last couple of years, then you could have a 2.5, 3%, 4% mortgage that you're taking over, which is great. It allows you to pay down build equity, pay down the principal a lot faster. And guess what? This debt is not in your personal name. So subject to is a great strategy. It works a lot when you start looking at, our clients, that when they're working with people in pre-foreclosure, is a great strategy because you're able to bring the mortgage back out of arrears and bring it back into good standing. And from there, you're able to make the payments and take over control of it. And from there, you have multiple strategies that you can use to implement to move the deal. Whether you want to keep it as a rental or you want to just go in and do a complete sale, you have the option. Seller financing, one near and dear to my heart. We're in the process right now of wrapping up our 84 unit portfolio down in Montgomery, Alabama, that we had 3 years of 100% owner financing on two of the complexes that make up the four total in the portfolio there. And we're in the process of refinancing those, but 100% seller financing on the 24 unit and a 20 unit. So yes, you can do 100% financing on multifamily as well as single family. And we've done it from single family duplexes. And most recently, in 2022, 2023, with substantially larger multifamily deals, you can do seller financing where, guess what? The seller becomes the bank and they finance it. And guess what? All my seller financing transactions that I've done over the last 15, 16 years, guess what? Not once has a seller asked me, hey, let me pull your credit report. Or, hey, go bring me your latest last 2 months bank statements. None of that. And the process is essentially now the bank is the seller. They're financing your loan. And if you have a great relationship, which when you're going through any transaction in real estate, relationships. You should be going and striving to build a relationship with your seller, their agent, if there's an agent involved, or with your bank. There's so many relationships that go into each and every transaction. But seller financing is one that you can really take advantage of in this high interest rate environment that we're in right now. Because guess what? If a seller is motivated, they want to sell, and they don't, and they can in a position where they can be the bank, you're their best friend. Because guess what? Now if they sell a finance, they're not receiving a lump sum that they have to go pay capital gains taxes on. So you're saving them on taxes. And guess what? Now they're still getting recurring income coming in from your monthly payments that you're giving them without the headache of being a landlord. And so seller financing is a win for everyone. And that's what I really love, because that when you look at the leverage that now you can go in and you could be 100% owner of a 24 unit that you did, because guess what? You don't need to raise equity. You don't need to bring private investors into your deal. So it gives you flexibility to build wealth at a really fast level. With that, wrap mortgages is another strategy where you go in and you wrap the existing debt and you bring in another level of debt, or you wrap the mortgage to go. It's a little bit more exotic, a little bit more higher level with that. But that is another option that you can look at using, especially kind of with subject to, where you go in and you can do a wrap mortgage where you have the baseline financing, but then you may go in and bring in another owner that wants to rent to own. And so you go and give them another mortgage on top of the debt that's tied to the property, where you give them terms where they do a lump sum down payment, and then they make payments over an extended amount of time. So you can wrap the mortgage. So that's always an option. Real world deal structures, like there is nothing that beats doing real live deals, like getting out here, understanding how to put a deal together, because the only thing you're limited by is your creativity. And so I'll say that again. Your only thing that you're limited by when it comes to putting transactions together is your creativity. Because if you have the number one ingredient, a motivated seller, then guess what? If you can create a win-win situation, guess what? You're going to do extremely well. And so that's one of the things that I want to encourage you, is to kind of open your aperture, learn these different strategies we're talking about right now, but looking at different structures of how previous deals have been done. I just talked about, in regards to the 24 and 20 unit that we bought with those complexes, that we had a 2-year base term with a 1-year extension option. The underlying interest rate was 7%, and it goes up additional 1% if we execute the option to go into that third year. So it goes from 7 to 8%, and it's interest only. And so, guess what? With these properties, we had over $300 upside because the rents were lower than the market rent. And so, that was the opportunity for us over the next 2 to 3 years to force appreciation, which is in multifamily, it increases the value. And so, that's the thing. But there's so many different ways that you can go through and structure these deals where you can limit the payments that are out of pocket up front. So you can do interest only, where you're not making principal and interest payments. Or, hey, if you're not really looking at a cash flow play, it's like, hey, we can look at, we're fine with paying principal and interest. And a lot of times you create the interest rate that you want, because guess what? If you lead the conversation with the seller, that you could come in and say, hey, how about I just pay you $1,500 a month towards the principal? And boom, and they're like, hey, that's a good return. I'm fine with that. And now you hadn't even talked about interest rate, but you're paying down 1,500 that's going 100% toward principal, no interest. So it's all about how you present the terms and how the conversation goes, and making sure that above board that you're clear. You're clear on the terms. You lay it out in the contract. Your attorney, the closing team, they have everything in place, and you get it documented, and you're off to the races and good to go. And the big thing that I talked about a little bit is just creating win-win offers. And so that's one of the things when it comes to negotiating deals, that is critical that you listen more than you talk up front, to understand the seller situation that they're in and the problem that they're trying to solve. So guess what? You can be their knight in shining armor that's coming with the solution, because you listen, you understood the problem, and it go through. And so the big thing that kind of with you guys that are kind of maybe newbies and looking to get into doing more transactions, that there's a lot more to the terms than just the price. So we're talking about the interest. We already, in the scenario I gave you, we talked about the interest rate. We talked about extensions, where you can push the contract out, the terms longer on the pay period. But then also you're able to increase interest rates. If you execute a term, you can do interest only, or you can do principal and interest. And so you have multiple options that levers within there that you can pull to make this a win-win deal for both you and the seller. So we really love the creative financing piece. HELOCs. This is one we really dive in because I would tell you that right now, if you look over the last 5 years, that on average in the United States, and every market is different, but on average, that most homes have appreciated over 40% the last 5 years, over 40%. So guess what? If your house was worth $100,000 in 2020 to 2019, then in the right market right now, your house is worth 140,000. It's going up 40%. And so HELOCs allow you to tap into that equity that you have in a home. And so this is one that I hit home all the time. Like in the United States, investors win. When you invest in companies on the stock market, you look at where the stock market was in 2008, 2009, and look where it's at today, to where it was 2019, where it is today. And you look at that, look at the price of real estate for homes in 2009, 2010, where they are today. The appreciation we just talked about, they went up 40% the last 5 years. If you owned assets the last 5 years, whether it was on the stock market, with equities, or if you were invested in real estate and you owned assets, you owned your home, you own rental properties, you are winning. And guess what? That's what happens with inflation. That's why I love real estate, because I was able to build a business on buying dilapidated assets, rundown assets in real estate that were a hedge against inflation. I can improve the value, make renovations, bring them up to 2024, 2025 standards. And now I have an asset that cash flows. I get tax depreciation from the IRS, where it goes up in the value, appreciates 40%. But guess what? In the eyes of the IRS, they give me a depreciation to write off the income every year. And then guess what? My residents are paying down my mortgage each and every month for me. And I get the long term benefit of over time, real estate is going up in value. And so that is one of the great ways to build wealth. HELOCs allow you to tap into that equity without selling the property. Great example. Right now, we were blessed. When we bought our home in 2020, we refinanced 2021. We got a 2.65 interest rate, and I'm not selling. But guess what? Yeah, I bought a Wells Fargo foreclosure, and when we came in, one of the things that I identified when I was looking at it on the map and Zillow, I'm like, hold on, this price here is 700K, but everything else around here is like 900K. I'm like, oh, okay, opportunity. Use my VA loan. It was a jumbo VA loan, so we had to put a little bit of money down out of pocket, and got the property. And lo and behold, now 4 years later, we purchased, and the value's gone up over 500K in less than 4 years. But buying in the right area, buying a foreclosure, putting about 40,000 in it, doing the renovations, and now I'm not selling because guess what? I have a low 2.65 interest rate. I can use a HELOC, a home equity line of credit, to tap into that equity up to 85% of the new value. And now I can go buy other assets. I can go and invest in apartment complexes. I can go buy a single family home to fix and flip. And guess what? I don't have to go get a hard money lender. I don't have to go raise capital. I can just go pay myself back and use that capital. And so it allows you to tap into equity without selling the property, which is critical right now. If you've owned your home for more than 3 or 4 years, you are sitting on equity right now. It's highly likely you're sitting on equity. The thing that you have to do is learn how to leverage it, how to use it. I had a meeting earlier this week with a client. Two properties owned free and clear. One needs about 90K worth of work. The other one, it has a resident in it. And so working through that, hey, by the way, they were able to go and get a HELOC on their personal residence. And they want to look at, hey, we have two paid off. We have a HELOC here. How do we put this together? What should I be our strategy? And I love these kind of conversations with my clients. We're going because now they have a strategy on how to leverage all the resources that they have at their disposal and how they can leverage those. But now, hey, let's go get a debt service coverage ratio loan on the one property that we have a resident living in that is for own free and clear. We're going to get debt on that one. We have the HELOC. Guess what? We can use the HELOC, make the renovations on the property that doesn't have a loan. And once it's renovated, go get a DSCR loan on it and then pay yourself back, pay the HELOC back. And then guess what? Now they're going to get into the multifamily space. We're getting a small apartment complex, sub 10 unit, and find that to take it to the next level. And that's how you do it. Liquidity as a strategy, I kind of went over the fund down payments on renovations. That's the strategy. Like you're leveraging this resource. Now you become your own bank. And now you're financing your own investments with the fix and flips, the strategy, or you can go and do. I look at, my strategy is buying small apartment complexes, do the renovations, then refinance it, keep it long term. So I'll do a short term loan on a 10, 20, 30 unit property, go in over the next 12, 18 months. We're going to improve it, force appreciation, and then we're going to refinance it and pay that short term loan off and then keep it for cash flow going forward. And do that. So you have different strategies, but now you have a resource where you can tap in for down payments, and it becomes a lot more predictable, and you're not asking the bank, you're not looking for approvals, and so now it just sets you up for long-term success with that. Got a couple questions here. One said, would you recommend using a HELOC to pay cash for a property, then refinance it later? 100%. 100% investor success mindset. That is a great way to leverage it. The big thing that you want to take a look at is the impact that potentially could have on the HELOC, because the HELOCs do report to your personal credit, that you want to be cognizant of the impact that it could have to your credit score, because to go in and refinance it later, they're going to be pulling that credit score and under looking at that to drive what interest rate you're going to have on that refinance loan, whether it's a debt service coverage ratio loan, which your LLC can go and get those type of loans. It's more statement based, but they're going to still want you to have a 680, preferably a 700 plus credit score to drive that. And so just understanding that trade off with the HELOC and what the impact could potentially be to your credit when you're doing that. But that is a great strategy and way to go. And the thing is, it's like, okay, if it's still cash flows and I have to pay a little bit extra higher interest rate, but it was an infinite return anyway, because I just use money for my HELOC and then come out my savings account. Some investors are fine with that. I'm one of those investors. It's like, okay, if I do it, refinance, I got all my money out. If I'm paying a little bit higher, but it's still cash flows, then I have no money in the deal. And so it's still profitable. And I'm a long-term investor with that, but I always want to have cash flow. So just understand what that interest rate hit may be if your score drops a little bit with the HELOC. Great question. Nomadic Soul, he said, hey, Johnny, how would you approach a seller who's open to seller financing but doesn't understand how it works or why it benefits them? Thanks. Yeah, no, that is a great question. And it starts, and I talked a little bit about it earlier, that with listening and being able to not talk as much, but listen to the seller's problems. And with all this, is the education. One, your education is going to be paramount. The best return on investment you'll ever have in your entire life is the investment that you make in yourself. So the more you're able to become educated on their problems that they're having, now you can put the solution, because guess what? You've been doing the work, you've been understanding, you're reading, you're seeing case studies on different deals, how to structure them. Now you can create a win-win. And now it's just on you and your communication ability to translate on how it benefits them. And the rest is it'll be history, but it's really understanding how you can put the terms together to meet their needs and solve their problem. And so the thing is that if you're not a clear communicator, or if you're not confident, then it could be a challenge with being able for the seller to see your vision and how this can be beneficial to them. But I would tell you, the number one benefit that I've seen in all my seller financing transactions has been not having to pay taxes, the capital gains taxes. That by and large, that has been the number one seller for them. That they become the bank, they don't have to worry about paying the IRS a lump sum of money, and it relieves them of the responsibility. A lot of the clients that I have worked with that were sellers, that they're up in age, the apartment complex, for instance, that I talked about, the 2420 unit. This gentleman was 82 years old, was tired of being a landlord, even though he had owned that complex. He had developed it like 25 years ago. And he had a property management company, but he was done. He was 82. He was like, I'm done being landlord and everything. And, they have the family trust, because we're going through the refinance now. And you just talking with the family and like, hey, yep, these proceeds are just going into the family trust. And so a lot of times that you see right now, this is the opportunity going into the future that I love sharing my clients, and how we target the right sellers is there's a lot of baby boomers that's getting out the game. And so it's like, hey, how do we add value to these individuals and present an opportunity and offer that shows them how they can get their time freedom and how they can save on taxes, and they don't have to worry about the tenants, toilets, and residents and the issues there. And so once you present that those freedom objectives and how you can make their life and improve their life, like, hey, it's a no-win. So that's why you listen, because you may have his wife that may be right there. She's like, he's always at that property, and he's never here on the weekends. He's over there doing work. And so now it's like, hey, yep. So we're gonna go with this seller financing option. I'm gonna take over the property in less than 30 days. You won't have any tenants calling you for any renovations, and you'll never go to that property again on the weekend. Now, boom, when they hear that, boom, his wife is like, we're selling, let's go, that's my guy, because I listened to them. I understood what their challenges were. And so that's the thing, that as you become more seasoned, that you can pick up on those cues on what the problem is and how you can solve it and move from there. But yeah, definitely it's all about communication. Investor success mindset. Okay, what factors would you consider to ensure the property is cash flow positive after the refinance? Yeah, so that's just creating your model. So the thing that you want to do, you want to go in and create a model, or Excel, worksheet, spreadsheet of the data. So you're going to look at projections best as you can. You want to be, I like to be conservative, but a lot of times you look at the pro forma or the projections that a lot of realtors give you that are garbage. Um, because a lot of times they're trying to sell you on the future and what the future value of these properties will be. But you want to definitely do your due diligence financially. You want to look at the current level of rent collection, where they are right now. Look at the current level of the condition of the units. Where can you make improvements? What are their expenses right now? Are there areas where you can recoup some of those expenses? One of the ones that we just implemented first quarter of this year, at my apartment complex there in Montgomery, was we did a rub where we started charging the tenants for water and sewer. They're paying a $25 fee now, because previously the owner was paying the water and sewer out of pocket. So that was one we implemented, where we're going to reduce that expense now. So it's really all about going in and understanding where in the future where you can increase income. If they're $200, $300 below market rent, then okay, now you can charge $200 more 2 years from now if you renovate all the units, or maybe a little bit less. And so you take all those projections, you kind of look conservatively of where you think interest rates may be at. There's data out there, that's projected. It's not 100% accurate, but it's the best guess based off today's um, financial picture for the economy. And so you get these things with the interest rates, where they may be at the 3 year mark, 5 year mark, or however far out you're looking to potentially refinance, and you're looking at how much you can increase the income and reduce expenses, and then boom, you have a value or evaluation for the property, on where it potentially will be in the future. And then now you can make decisions on, if I can push this property. One of the things with the portfolio, our basis, we bought all four complexes was 4.32 million total, where we are right now for debt, and it appraised for 6.2 million. And so that's the thing, that over 2 years we're able to force over $2 million in appreciation in the complex. And so now, and we knew that going in, our target was, to actually force 3 million, but we were a little bit behind on the business plan, with some different challenges that we face. But we still have on average $192 of rent increase across the complex that we're going to achieve here over the next year or two, to kind of make up that additional million, and a little bit more than that for us, what the new valuation to be. So you want to definitely look and understand the numbers, because all this is math. It's fifth grade math. We're just adding, subtracting, multiplying, and dividing. But you want to make sure that you have those numbers in place, to make sure that it's a good investment. What factors would you consider? No, most definitely, 100%. You're welcome. And yeah, so that's the HELOCs. HELOCs are a great strategy, and one of the ones I have mine with Penn Fed. There's some other companies out there that are really great, and the process takes you 3 weeks, 4 weeks. There's some out there right now that are advertising they can get you done in 2 weeks. Because the cool thing is that it's your primary residence usually. There are some HELOCs that you can go and get a portfolio loan against, like your investment properties. There's loans that you can get against those as well too. I've done that on an apartment complex, where going in and I was like, hey, no, we refinanced in 22. I know the value is up there, and I only owe you guys like 50% of the value. It's like, hey, can I get 150K line of credit? It's like, yeah, let's pull your credit, do application. 3 weeks later, boom, it was approved. And on the personal side, with like your personal home, you own the asset, you're already paying the mortgage, so it's low risk for the bank. And so it's a straightforward process. They pull your credit, look at your tax returns, and see whether or not you have a homeowner association bill. They go through and look at request the tax transcript and little things like that. And sometimes they can do like a desktop appraisal. They don't drive-by appraisal. They don't actually have to come in your house. And 2 3 weeks they give you up to 80 85% of the new value of your home, and you can tap into it just like a credit card. And you can see terms anywhere from like 3 years to 10 years where you can draw it down, pay it down, access it again. And then after that term is up, whether it's at the 3 year mark or 10-year mark, then it will go into a fixed rate loan, and then you just make your monthly payments for the next 20 years. And so it's a really good, great opportunity. And the interest rates, because it's secured by your home, are a lot lower than a personal loan or than traditional credit cards. For sure. Right now, I'm seeing quotes somewhere around 10, 11% is what you'd be somewhere paying with decent credit on a HELOC. So yeah, love HELOCs. It's a great tool to have in your tool belt to get deals done. Oh, the multifamily pivot. Like there's a lot going on in multifamily that with interest rates, there were a lot of transactions that happened the last few years before rates started ticking up in 22, that a lot of we're talking about underwriting and looking at the numbers, because a lot of people had aggressive underwriting in order to get the deal done, that they projected, hey, the capitalization rates were going to still be fairly low, and the exit when they got ready to refinance or when they got ready to sell the property, that the interest rate environment was going to be 4%, 5%. And now we already know the last 2 years rates have been anywhere between 6 and 7%. And they didn't put that level of won't say scrutiny, but they weren't that conservative to project using rates that high on the impact of what the deal would look like when they bought it. And so it tripped up a lot of people. You're seeing foreclosures that happen. I think the crazy part that happened, that, with any operator, they weren't able to predict, especially in certain markets like Florida, California, where not interest, but insurance doubled, tripled the last couple of years, just with all the natural disasters. And so it was things like that where operator could have predicted that their insurance was going to double or triple. And it puts you in a bad place as an operator, especially then if you're in a growth market of like a Austin or Dallas, where you had a lot of inventory coming online that was brand new. People had a lot of options. Rents started going down progressively because there was so much inventory. People had to lower rent just to lease up. And so if you're in one of those markets like that the last couple of years, it could be extremely painful. Your occupancy is going down. You're not able to make your renovations. Your insurance costs is going up. Your taxes have increased on you. And now all the time, all that's dragging your cash flow down. And, subsequently, we've seen a lot of foreclosures. Not as many as a lot of people had projected with the pain, but a lot of people, extensions, extend, they say right now, extend to pretend, until rates go down. But I think rates are going to be here kind of steady where they are now with the tariffs. With the inflation projections, they're saying inflation may get back up to 5%. That's great for real estate investors, by the way. But where the economy is potentially, and the expectancy that we could see rates for higher, which just puts, depending on your deal, you could be in a tough place, which goes into number three with the multifamily pivot, that we're seeing a lot of institutional money and a lot of investors that are looking to pivot from the C class value add proposition with multifamily. You take a multifamily property that may be 10, 20 years old, 30 years old, and renovate it, increase the rents, then now they're going directly just build to rent. And with the high interest rate environment, with the increase in construction labor costs, the increase in materials, that right now is getting very, very cost prohibitive to do these type of deals right now. And just where interest rates that, when you look at, hey, if the bank's only going to give you half of your money or 60% of your money, then now you got to go raise the rest of that equity on these bigger deals. And that's why I love smaller apartment complexes, because guess what? I don't need to go raise a lot of equity. I can get into the deal and I can get out and really quickly. And I don't have to go and raise a whole lot of money. I don't have to go and get a bunch of partners. And guess what? Then I can just cash flow it and keep it moving. And so the pivot is happening just because of the nature of the environment. And so that's the thing, that you can't be a 2025 investor investing now and still have a 2020 mindset. That you got to grow, you have to grow and evolve with the economy. And because real estate is cyclical and it's constantly evolving, and if you're still stuck trying to do fix and flips and thinking you're going to go out here and you're going to sell a house that you're going to have 10 offers on day one, then yeah, the market's changed, and you're going to get left behind, and those are going to be some painful mistakes. And so that's one of the things that you see with that. But there has definitely been a rise in the build to rent communities out there, and definitely in like the Nashville's, the Houston's, the Dallas, the large markets where we're seeing a lot of job growth and a lot of population growth, that you're seeing these build to rent communities. Because right now in America, this is the most, I would say this has been the point in time right now where it has been least likely for you to be able to buy an affordable home. That the gap on affordability from what it costs to own a home versus rent has never been this wide. And so right now, more people are looking to rent because they can't afford to pay a 7% interest rate. The average house, what, 400K? They can't afford to that. You need to be making 125, 130,000 a year, and I think the median wage, household wage, is still what, 60,000. So yeah, most people can't afford to buy right now. And I know in our market, when we were looking right now, the last 23, 24, there's a total of 24 units that permits were given out for new construction and multifamily. But also, one of the things that data provider gave us was right now, 80% of the people in that market say they can't afford to buy a home. So guess what? Now you're gonna have 80% of the population looking to rent versus buy. And so for landlords, that's great. That's a great place to be. And with the institutional money, they have a lot of the money that can go and buy 100 houses to be built in an area right now with the institutional buying trends. And that's one of the things we saw with COVID. They started buying single family homes because guess what? The government printed all this money, and and they knew, hey, inflation is coming with this much quantitative easing and stimulus being put into the market. That guess what? Inflation's happening, and guess what? Real estate is one of the best hedges against inflation. So they started buying real estate. And so the thing is, like, as these institutions shift their money and the smart money, and you're getting educated, and you just follow the wave. You understand where Congress is going with the taxes, because tax laws are set up to incentivize investment in certain areas. Because guess what? The government doesn't want to be a landlord, so they incentivize real estate. They give landlords write-offs for all their expenses. They can write off their mortgage interest, as well as they give them depreciation. And one of the great benefits that came out of the Tax Act of 2017 that they're looking to renew this year was 100% bonus depreciation for commercial real estate. And so that's a phenomenal strategy on how to defer taxes. And when you're buying these commercial assets, that is really, really impactful to your bottom line. So the pivot to build and rent, something definitely to be watching. So we answered some of these questions already. I didn't want to make people kind of hang out and wait. But it's your time. If you got a question and you're kind of watching right now, feel free to kind of comment in the chat, and would love to answer some questions live this evening. All right, earning yearning. Good evening. Says a buddy wants to partner on a multifamily deal, but I'd be putting in most of the money. How would you structure that fairly? No, that's a great question. That's a great question. Number one, make sure that you have an operating agreement for the LLC. 100%. Make sure that you have an operating agreement. Whatever you're doing business with, anybody, if it's your brother, your mother, or anybody, make sure you have an operating agreement in place that documents how everything's going to happen. If that individual, if your buddy's doing all of the day-to-day operations, and one, make sure the roles and responsibilities are included in the operating agreement that your attorney puts together. And but you want to make sure the lanes are road, that easily, if you're bringing the capital and they're doing all the sweat equity, then 50-50 it could be potentially be fair. If you're involved inside the transaction as well too, maybe we bump it up 60-70 if you're bringing the funding and you're providing some of the investors relations, the asset management, the day-to-day operations there. So but just like what we're talking about with the sellers, it's all about creating a win-win for both of you. Something that's fair that you both can agree with, and then document it. Document it on the front end. What happens if somebody gets divorced? What happens if we fall out? What happens if one of us wants to get out the deal? And kind of have those different scenarios on how that works. And it can't be, and I'll take that back. It can't be 50-50. Somebody has to be able to make the decision. Somebody needs to be in charge at the end of the day. So you want to kind of think through some of those situations and be comfortable with it. I think right now is a time to be cautious, to be I would say aggressively cautious, because you want to be cautious in what the deals that you're getting into, but you want to still be aggressive at the same time. And so I would say be aggressively cautious with how you approach it, but don't be scared to make decisions and really see kind of what this individual is talking about. Because I've been in situations where the partner kind of step away after a year and a half, and then guess what? You're in the deal. You got to go take. You got to take the reins and take it over and make it happen. And so the thing is, just kind of understand where are their long term goals, next 3 to 5 years. Are they in it? You know, what are they? Have they been through any type of adversity in the past? What is going to happen when something you get that call that somebody broke into an apartment or there was a fire in one of the units? Are they going to be able to kind of go through the different challenges that comes time to time? And so just making sure you know who you're getting in business with, because these relationships almost like a marriage, that you may want to do a little bit of dating, kind of see how this person does, maybe want to fix and flip before you get in a multifamily deal with them. And you want to vet them, check their background, their track record, as well as you may want to get a private investigator. If depending on how much money you're putting in it, that you may want to do a background check for sure, credit check, those type of things when you start talking about partnership, because it impacts you, your livelihood, and your hard-earned money, in this case with you. No, that's a great question, but you definitely want to talk to an attorney, 100%. Okay, he said I have experience. He's fairly new, but doing most of the back end things. Okay. Yeah. So if you're in the mentorship role where you can kind of guide and they'll listen, and as long as you got the paperwork in there, um, but yeah, I think you just you go with where you are. You're coming in with the leverage, with the funding and everything, and clearly with some of the experience that I think anywhere I would say 60 to 70%, where hey, they're gonna get 30 to 35% equity in the deal, and they're doing all the work. I think that would be fair, and especially if you're gonna have to be kind of fielding questions and still being involved. That I think that would be a win-win. No, but that's a great question, and one that comes up a lot, just with the partnership. Because the thing that I have learned over the last couple of years, yeah, no problem. We're working with clients that most of my clients, when they come in, they realize they're like, hey, what you do, the deals that you put together, I just want to be a passive investor in your deals. Because I don't want to be finding the deals. I don't want to be, working with the contractors, the property management, doing the asset management functions, or doing investor relations and things like that. I just want to be hands off. I'm great at my job. I don't have time. I still need to spend with my family, and I just want to be passive. And so now you have to make sure that you're vetting the right operators, that you have a good understanding on what you should be looking at in underwriting and deals that you're looking at investing in. What's a good deal look like? What does a bad deal look like? And now just kind of getting that information so you can make informed decisions on making partnerships or making passive investments with those deals. So they're super critical. Awesome. Okay, 7:40. We're a few minutes over, but that is good. I appreciate everyone tapping in tonight. We're gonna look to be doing more of these here in the future. I get ready. I start my skill bridge here as I transition out of the Air Force, the world's greatest Air Force, over the next 2 weeks. So I'm gonna have a lot more time to kind of go through and do some of these things and continue to add value and help. And one of the things that for those that are out there, great questions, looking to get more clarity before making the next move, or well, some people, if you wish you had a game plan, maybe you have equity in your home, like how do I leverage a HELOC to go to the next level or to do our first project? And that's one of the things. My wife and I, we're coming up on in June, it'll be 10 years since we did our first fix and flip together. So if those are some of the questions that you're having, then we'd love to have a conversation kind of jump on a call, kind of understand what it is that you're doing, give you my 2 cents from my experience with being a real estate investor, single family side, multifamily, raising capital, all those things, what I would recommend and kind of go from there. So if that's something you're interested in, definitely tap into the link there, johnnylynum.com/consultation. And yeah, have a one-on-one call with myself and just see what's out there and kind of give you some things to think through on how to go to the next level. And then potentially, if you're a good fit, we're looking to be one of our clients. We'll kind of share what that looks like and how to go to that next level as well too. With that, if there aren't any more questions, I appreciate your time. You all have a great night, and we'll see you on the next video. Let's go and let's make some equity happen together.